Hey everyone, thank you for listening to the Amateur Investors Podcast. Before we get into the episode, quick shout out to our sponsors. Need Bitcoin support? The pros at Coinbase Connect are here to help. Learn about self-custody, privacy, mining, lightning payments, and much more. Simply go to coinbase.com/connect and schedule a one-on-one video call with a Bitcoin pro. Take your knowledge to the next level by connecting with a pro on coinbase.com today. Please check out our episode 42 with Adam O, aka Denver Bitcoin on Twitter, and episode 46 with Hodl Tarantula. Both are pros you can connect with at coinbase.com/connect today. Have a good one, everyone. Catch you in this week's episode. Hello, everyone, and welcome to the show. My name is Chris Alamo.
And I'm Ben Gasaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it. Welcome back, everyone. This is episode 49 of the 48 of the Amateur Investors. I got legendary investor Greg Foss on here. Not newly minted Bitcoiner, but I know you've kind of come onto the scene within the last year, at least at last 20 months or so. So Greg started his career as a high yield bond trader for 15 years on Bay Street and Wall Street, and then switched sides to the buy side of things at two hedge funds focusing on credit, working at one through the 2008 financial crisis. Greg discovered Bitcoin in 2016, but ultimately, like many of us, went down the rabbit hole during the March 2020 liquidity crisis. Greg, thanks for coming on the show.
Pleasure to be here. Thank you for having me, Chris. And you know what? It's awful kind of used to say legendary, but that's far from the truth. I'm a concerned investor. How about that?
Sounds good. I've learned a lot from you already, so I really appreciate you coming on the show. So I guess I want to dig in. What I get with most Bitcoiners is ultimately what had you go down the journey of finding it in 2016, and what reinforced your investment strategy of going into more recently, I guess, coming up to 2020.
Sure. You know what? Honestly, I'm a Canadian, and I went to school at McGill University in Montreal, actually my hometown. But I went and did an MBA down in the States, and when I came back to Canada, I was working for the head office of Canada's largest financial institution, which is the Royal Bank of Canada, and lo and behold, I was working on a project that was focused on restructuring our Latin American debt exposure, starting with Mexico. And it was a plan advanced by Treasury Secretary Nicholas Brady to help out the global banking system. And the reason the global banking system needed to be helped out, or in other words, bailed out, was because the loans that they'd made at 100 cents on the dollar to lesser developed countries, LDC countries, primarily in Latin America, they'd all defaulted. And I did some quick back of the envelope math, and I realized that Royal Bank of Canada was insolvent in 1988. Now, that's a pretty horrible experience for a kid just coming out of business school. Certainly, they don't teach you that in business school. And you know, Royal Bank of Canada was not unique. And Treasury Secretary Nicholas Brady certainly wasn't making the Brady plan for the Royal Bank of Canada. He was making it for the JP Morgans, the Bankers Trusts, the Manufacturers Hanovers. These are all, some of them are banks that have been combined, Chase Manhattan, which is now part of JP Morgan Chase. So the global banking system was essentially insolvent. And all that means is that the book value of equity of the banks would have been wiped out if you had to absorb the loan losses on these Latin American debt loans. And that's a pretty scary situation, because most of the bank equity analysts had no clue. And they're still promoting the bank stocks as being, oh, these are safe. And depositors had no clue because they kept their money in the bank. And it caused me to question the whole system, even in 1988, because I said, how is this possible? And I realized there's a de facto put on the by the banking system on the government, and that the government will bail out the banks. They are too big to fail. And the way the governments do this is by printing money. So actually, to tell you the truth, I've been looking for the solution to the fiat Ponzi since 1988. I finally found it in 2016. And that's after a career of trading credit and looking at everything through a credit lens. And I could expand on why it's important to look at things through a credit lens. But the reality is I found Bitcoin in 2016. I went down the rabbit hole quite hard. It wasn't right at 2020 when I really embraced it. What happened was, though, that 2020 solidified the fact that we are now unable to ever escape the debt spiral that the politicians have built up in successive financial crises.
Yeah, a lot to unpack there. Thanks for that. So I guess when you saw in 88, when basically Canada's bank was insolvent, and obviously many sovereign nations, I guess in Central and South America, which I'm assuming the United States was no exception. I bet they had a lot of debt from those countries as well.
Well, no, sir, that's what I meant. So Wallstreet, the Manufacturers Hanover, the Bankers Trust, these are big money center banks based in New York City that were all in the exact same situation. It wasn't just Canada. It was the global banking system was insolvent.
So obviously they opted to print away their debt, but they're kicking the can down the road. I guess, I was not born in that time, so I won't date myself, but a little bit younger. But I guess I'm assuming that obviously they tried to like snuff out inflation by raising interest rates to compensate for that after.
No. So what would happen? Okay, the first crisis. So I've been involved in 4 financial crises. 1988 was one where they solved it using essentially accounting gimmickry. The accounting gimmickry was backing the loans with zero coupon government debt, U.S. Treasury debt. And those loans, a zero coupon bond accretes from a price of, let's say, 15 to 20 cents on the dollar, depending on the implied interest rate, back up to 100 cents on the dollar over a period of 30 years. So they essentially changed a 5-year loan into a 30-year obligation, at which point over the 30 years, these loans would be accrete back to 100 cents on the dollar. Now, in fact, they did trade even through 100 cents on the dollar because of things like Mexican risk improving, Mexican oil prices improving, interest rates declining. And when interest rates decline, bond prices rise. That doesn't matter. It was an accounting gimmick that wasn't a transfer of risk from the banking system to the balance sheets of the Fed and the other central banks. But what it was the first implication that the Fed would do anything required to save the banking system. And at that time, it made sense. The problem was nobody understood the implications. The next big financial crisis, though, was in 1998, and that was long-term capital management. And that was a Fed bailout based on stupid risk management practices at a very large hedge fund called Long-Term Capital Management that actually had 2 Nobel Prize winning mathematicians or economists on their board. And they acted as if they'd obviously never managed risk in their life because they put on some incredibly foolish levered bets where they were selling volatility to the street. Anyway, long story short, they were 99 to 1 times levered. And Wallstreet was buying all this insurance from long-term capital management. They were essentially purchasing volatility, and vol was exploding. And long-term capital management couldn't make good on their obligations. So the Fed had to bail them out then. Then the big one was the financial crisis in 2006, or say 2007, 8, and 9, which, I really did think the world was ending, or the financial world as we know it. But the Fed took the necessary steps to stop the bleeding in the system there from the subprime mortgage crisis. But that was a huge transfer of risk with programs like the Troubled Asset Relief Program, that's called TARP. Maybe I'm throwing out acronyms here that your viewers won't remember or don't appreciate, but here's the thing. You just have to realize that success of kicking the can down the road, as you said, we had a chance after that great financial crisis to actually reel it in and try and pay down some of the accumulated debts. But as soon as the government tried to do that, these taper tantrums caused equity markets to go into a tantrum, essentially, or a tizzy, and the Fed backed off, putting their foot on the brake. And incidentally, if you come into politics as a 4-year politician and your whole platform is, I'm going to be austerity and I'm going to cause, we're going to pay down this debt and the economy is going to suffer for 4 years. Do you think people are going to vote you back for another 4 years? No.
Absolutely not.
So it's not surprising that they didn't pay down the debt, but they did have the chance until 2020. Then they just lost their minds. Okay, now I'm a capitalist with a heart. I understand the necessity to try and take care of the people less privileged. But at the end of the day, you're really just punishing everyone when you continue to print money. According to the modern monetary theorists that, again, have never traded risk. They sit in their ivory towers.
Right?
I'm sorry?
The Stephanie Keltons of the world.
Well, I'm not going to name names, but let's just say they're not great at mathematics and they've never traded risk. And you have some politicians like AOC who goes out there and say, well, we'll just print more money. The repercussions of that are so punishing, actually, to the people that it appears that we're trying to protect at the outset. So this is where we are. And 2020 solidified it for me that there is no alternative. Bitcoin is the only solution to the fiat money Ponzi.
Yeah, I mean, I think you and I are very happy to own Bitcoin instead of not having it. I honestly, the people that are no corners that don't own any, and either whether they have a lot of wealth or they don't, this is kind of the outlet that I mean, you and I and many of the other Bitcoiners see this as the outlet for basically the collapse of what we know as the current economy or financial institutions as we know it.
It's not too late though, right? Everyone says, oh, I missed it. I need to stress to your listeners that Bitcoin is actually a better buy today on a risk-adjusted basis than it was in 2016 when I first got involved in it at under $1,000 US a Bitcoin. It's better value today.
Yeah.
And that's because the upside is equally as magnificent as it was in 2016. But after 5 years, the network is stronger, the adoption is happening, and the reality is the federal deficit and debt situation is absolutely irreversible.
Yeah, and I agree. I mean, you don't know my story, but I've said it a couple of times on my podcast. In 2017, I had a friend who or an acquaintance from college that was like, oh, we should buy Bitcoin. We'll all get rich doing it. But they had not they were not a traditional investor. It was kind of like the slogan of, I guess, when the crisis that happened, the Great Depression during 1929, there was a guy on Wall Street that was getting his shoe shined, and the shoe shiner was saying, oh, I'm putting all my money into stocks and this, that, the other thing. And that's when he ultimately sold out. The story goes, the crash happened a few weeks later. He was saying, when everyone's saying is it time to buy, that's the time when, ultimate greed and fear and all that.
Okay, fair enough. Look, everybody's a magician trader. This isn't about trading something. This is about purchasing insurance. Okay. Yeah. Bitcoin is an insurance policy. And much like house insurance, you purchase fire protection on your house, not because you want the house to burn down, but you're worried that you might be living in a neighborhood of arsonists. And we are living in a neighborhood of arsonists called politicians who do not understand the implications of print.
Oh, no, for sure. So 2017, I thought it was very much tulip mania. I kind of bought up into the mainstream media hype of it, saying, it's a Ponzi scheme, it's going to crash. And ultimately it did, it went down in value greatly from falling from 20,000. I think it went down to probably even the 3K range. Yeah. And then I really kind of put it on the back burner, didn't look at it until ultimately 2020. And I guess I'm like a Sailor that I know he said he bought January 4th. I think my first purchase was in June of June 7th. So a few days later after Michael Saylor, obviously he announced the street in August after it all cleared. But, now I've kind of went down the rabbit hole and see the real proposition and value of Bitcoin. And I agree with everything that you said. Like, if there was a chance for it to fail, definitely 2017, maybe even earlier of 2013. But right. I think now with network adoption, it's growing faster than the internet. People are really, we've got El Salvador news. It looks like potential other countries, potentially Brazil, Paraguay. I kind of looked at their laws. It's more cryptocurrency instead of Bitcoin, but I'm all for the free and open markets. And if they want to play stupid games and win stupid prizes, I'm all for that as well.
Yeah.
So
well, look, it's only mathematics, right? You got to rely. I'm an engineer by training. You got to rely on your math Mathematics is the base layer of language. Mathematics is also the base layer of Bitcoin. I'm not certain that these other cryptos, let's say, have the same, well, in fact, I'm totally certain they don't have the same characteristics and protections that the Bitcoin protocol has. But look, you know what? You need to own other hard assets besides fiat currency. If you feel that some other altcoins exhibit hard asset behavior, it's better than owning fiat. Fiat is programmed to debase. That is 100% mathematical certainty.
For sure. So I guess I got a couple things. So I guess,
Sure.
I know in 2016, you kind of got, or you liked Bitcoin, or you're looking at it.
Yeah.
Ultimately, I know a quote from Jamie Dimon from JP Morgan was threatening his employees if they traded Bitcoin, they'd be fired back in 2017. I'm not sure where you were with what hedge fund you were at, or if you're still.
I wasn't. So I had retired prior to that, but I remember thinking, look, Jamie Dimon, I have respect for the man. He is a good banker, but it's sort of like asking a taxi driver what they think about Uber, right?
Yeah.
Asking Jamie Dimon what he thinks about Bitcoin, which he will be disintermediated by. He says people will be fired. The funny thing was, his daughter then turned around and said, "Hey, Dad, did you know I own Bitcoin?" He didn't even know.
Hear that.
Yeah. So, and he admitted it. And look, the best thing about being a good trader, or not the best thing, the best characteristic of being a good trader is changing your position when the information changes. Okay. There's too many people that get wheeled off of trading floors because they don't change their position as the information changes. Okay, I don't need to take pot shots at some of my favorite targets on this basis, but Jamie Dimon, look, he is a good trader. He's a good risk manager. I know he gets it. Does he want to announce to the world that his bank is going to be disintermediated by the most pure, the most incredible technological development in the financial system in the last, in history? He gets it, and he doesn't want to accelerate the disintermediation of his own bank.
I completely understand. And I know Mr. Munger, one of his famous quotes is, "Show me the incentives and I'll show you the outcomes."
Yeah, interesting you bring up Charlie Munger's name. I'm not sure. I just had to go off on him on a recent podcast because he's another conflicted, he's a successful and revered investment manager, but at the end of the day, he's absolutely wrong on Bitcoin, and he's giving horrible advice to the younger generations.
For sure. We'll definitely get to that. I'm actually glad you brought up. That was actually my next point. You were saying the best risk managers in the world change their opinion when the facts change. That was on What Bitcoin Did podcast with Peter and Dylan, actually. I know you were referring to Ray Dalio in particular. It seems that Ray's position, not that he flip-flops, I know taking his quote out of context, but he said he'd rather own Bitcoin than a bond. And I know you're talking about the mathematics of it. Mr. Dalio knows that going from 14% down to 0%, bonds are no longer a good trade. One of my favorite books was Money Master the Game by Tony Robbins. It was written in 2016. So a lot of the psychology and the mathematics and all of the principles of what they're saying in it are good basis. But like you said, the facts have changed since 2016. In the book, Ray Dalio mentions his all-weather portfolio, which talks about, the allocation of bonds along with equities as to hedge and all that. I'm sure you're very familiar with that. And I don't see that as a very good trade anymore, as do you.
Well, it can't be, because math, when bonds are at 1.5%, okay, the US 10-year 1.5%. Let's run through some math, okay? When I started trading bonds in the 1980s, US 10-year rates were close to the 14%. It's a 40-year bull market in bonds. So mid 80s to 2021. So 1981 to 2021, 40 years of generally declining interest rates. When interest rates decline, the value of bonds goes up. That's just a mathematical, it's based on duration and convexity, first and second derivatives of a bond price. And your duration and convexity is very sensitive, or not your duration, your bond price is sensitive to duration and convexity. And the problem is, or not the problem, when interest rates are at 1.5%, if they go up by 50 basis points to 2%, on a 30-year bond, just doing back of the envelope math, the duration of that bond is about a 20. which means 20 times 0.5% means you lose $10 on the price of a bond, of a 30-year bond. You lose $10. Now, if the coupon on a 30-year bond is 2.5% right now, that means you basically lose 4 years of interest coupons in a price move of 50 basis points. That's all it is. It's bond math, okay, Chris? And it's important for people who have lived 40 years of it going in the other direction, where they're saying, oh my God, interest rates dropped by 50 basis points, so I made the $10. You never made anything. You just pulled forward the gains on your coupons on the bonds, because those coupons were higher than open market interest rates. And those caused the price of the bond to go up. And Mr. Dalio put together a very smart program called Risk Parity, where he traded the volatility of equities against the volatility of bonds. And that works when interest rates are in a declining rate environment. But guess what, Ray? They don't work when interest rates are at 1.5% and trending higher.
And that's not even factoring in the deflation of the currency on top of that.
That's the big, well done, Chris. That's exactly the point. Look, a bond is a fiat contract, and the underlying fiat is now programmed to debase. Over a 10-year period, you may well get your $100 back. It's highly likely, but not certain, that you'll get your $100 back on the US Treasury debt. Okay. The reason it's not certain is there's something called credit default swap insurance. And that insurance costs more than zero, which means people are willing to pay for that protection, meaning there's uncertainty in the market as to whether the US Treasury will make good on their obligations. But let's just say it's very highly likely still. It may not be that case. And they're playing with fire with this whole debt, pretending that a debt default will be anything less than catastrophic. I mean, these people really have to get out in the markets and understand what they're talking about, because they are looking like absolute fools when it comes to playing with a debt default. But back to my point, in 10 years, you'll get your money back. The purchasing power of that $100 that you lose over 10 years is substantial. Maybe it's 65% of the purchasing power, and that's what you get back. Yeah. You lent them $100, they used your money, and in 10 years, rather, you get the $100 back. But you lost 35% of your purchasing power. What a goofy contract. Anyone who's in bonds right now needs to have their heads examined. They failed math 101 or bond math 101. And the reality is very few people understand bond math 101.
Yeah, I'm an engineer by trade as well, a chemical engineer. I think you were mechanical. I looked it up.
Yep.
And I agree. So I've definitely had my fair share of math classes, some of them more difficult than 11th grade math, but I know even me. So I'm much younger than you. So I was in college in 2008, a freshman, when the financial crisis happened. I officially got into the working world. I was in high school then. My apologies. I officially got into the working world in 2015. So graduating college then.
Okay.
I know my dad was always big in going equities over bonds for all of that time. I never really looked at the bond math of it, but, just kind of looking at adjusting your risk. But he was kind of looking at it more of, this is what your rate of return is for bonds. This is what your rate of return is generally for the market, S&P, the NASDAQ, and all
gosh,
that.
Bless your father. That's cool. But you need to understand that equities are not a contractual return, and bonds are. And you may say something like, well, dividends are on equities. And remember, a dividend is not a contractual return. If a company stops paying their dividend, there's no default.
Yeah.
Okay. Whereas a bond, if you stop paying your interest and principal, that's defined as a default. And there's a restructuring event that takes place. People do not really truly understand how IRRs, or internal rates of return, are calculated on various instruments in the financial markets. It's dangerous. It's a reality. Everyone gravitates right to the equity market first because, it's transparent and you can own a piece of a company. But listen, it's all directed by the credit markets. If you don't understand how credit works, you are a sucker at the table. And generally, if you don't know who the sucker at the table is, as they say, it's you. Okay.
Yeah,
and
sure.
Most of the people that sit at the equity table are suckers.
Yeah. So, I mean, he was more, and he's kind of more of the traditional advice of doing the broad index funds. He's done that over the course of his whole career. I'm the one that actually got him into Bitcoin. And,
well done.
Yeah, so he owns some now. I'm proud of him for that. But yeah, but kind of to your point, I started looking into the credit markets because the bond markets never intrigued me. I kind of knew the mathematics, and they're boring. They're not as cool. They're more simple mathematics or complex mathematics, however you want to look at it. Obviously,
they can't grow to the moon, right? You buy an equity, you very rarely double your money in bonds. Okay. I mean, you can double your money in distressed debt, but don't forget that someone who buys bonds at, let's say, 40 cents on the dollar because it's distressed is buying it from someone who bought it at 100 cents on the dollar and has lost 60 cents on the dollar. And you can get from 40 cents back to parity, but it's not guaranteed. And it's a risky business dominated by very sophisticated players that are very comfortable in the courtroom sometimes. Yeah. Whereas equities, there's plenty of stories about people who buy a $1 per share stock and it goes up tenfold. I mean, that the problem is that gets people into the market. There's 30 times as many stories as people who buy a stock at $10 and it goes back down to $1, but no one ever talks about those ones.
No, for sure. And he was taking more of the safe play. He was kind of buying the market.
Oh, look, please don't take it as if I was criticizing your dad by any means.
No, not at all.
Yeah, because he's a smart guy. He understands risk and return. And my father was in the same boat. Okay. I'll just tell you, though, that I traded credit for 30 years. I have never seen a worse risk return opportunity in bonds in my 30 years, irrespective of the fact that the currency is going to get demolished. Okay. So it's just, it's ridiculous.
Yeah. And so I guess in going down my journey of investing, kind of starting the Amateur Investors podcast and stuff, I completely agree with your sentiment. I mean, I'm looking for people like you and your wisdom of trading the credit markets, that there are the underlying basis of the greater economy or the equities market. Obviously, normally when you see distress in the credit markets, that will ultimately move its way into the stock market. I forget what the quote is. I think it's, the credit markets say what's going to happen. The equity markets are the signal of today, where the credit markets are the signal of what's going to happen tomorrow. I'm probably butchering
I haven't heard that one, but here's how I like to describe it. Look, the equity markets are a subordinate claim to credit. Okay. Mm-hmm. And as a credit trader, I can promise you, I was shorting stocks to equity buyers that had no clue where the supply of the stock was coming from. And it's because I owned the bonds and I could sell with confidence the equity as a hedge against the bonds on a delta adjusted basis or a risk adjusted basis that hedged my default potential on the bonds by shorting the equity. And why is that? Again, capital structure 101 is that bonds rank senior in the capital structure to equities. And if the bonds in restructuring don't receive 100 cents on the dollar, equities receive 0 or their claim is 0. Now there's restructuring agreements that cram down the recovery rates on the various classes of creditors. But point being, the equity market is the tail and the credit market is the dog, and the poor tail gets whipped around like no clue what's happening because these equity investors have no clue where the bonds of the company are trading, including the fact they don't even know that it actually has bonds most of the time. Yeah. Oh, it's a high yield borrow, is it? What does that exactly mean? Well, understand this. If you own the equity of a high yield or junk bond company, you own what's called super junk, because the equity ranks as a subordinate claim to the already pejorative junk bond.
Yeah.
My God, junk bonds are horrible, but let's own the equity. This is what makes capitalism great, but also capitalism so foolish. The silos of the various asset classes.
For sure. And I know, I mean, you would probably know better than me. I know the 4 highest yielding or the high dividend yield companies. I think it's Ford, GM,
AT&T, Ford, AT&T, General Motors, and the 4th one, General Electric.
Yeah. So I know that, I mean, a lot of the baby boomer generation and older, that's a lot of what they do as their fixed income in retirement. So God willing that any of those default, that could be a lot of people's livelihood on top of obviously Social Security or social programs that us in Canada have. But I know that it would cause calamity in the whole world if those 4 companies collapse.
Well, those 4 companies, the combined or the consolidated balance sheets of the 4 of them is bigger than the entire high yield bond market. Okay. The overwhelming supply into the high yield market would crush the high yield bond market as a whole, not to mention what it would do to the stock market, because the stocks of those companies would be used as cannon fodder to hedge the bonds. Okay. So like, it's just really something that most people don't appreciate. And it really comes to a crux when financial markets start to melt down, and it starts a contagion, a spiral of collapse of confidence.
For sure. All right. Not that I'm gonna put you on the spot, but I pulled up the national debt clock, and I know you and Dylan have both mentioned, I don't know if you could use this just using a snapshot. I can share my screen right now.
Oh, it's okay. I know where it's going to be. Like, let's not worry about it. It's not. And by the way, that's only the, that's your on balance sheet liabilities. Your off balance sheet liabilities, like your Social Security and Medicare. Well, it's about six times the size of the national debt clock.
They actually did include that on there.
Oh, did they? Okay.
Social Security, Medicare, and unfunded liabilities. But I guess I know you.
So where is the one that says everything then? I haven't seen this one. So where's Social Security and unfunded?
Social Security.
Oh, right down at the bottom. Okay, that's beautiful. Hey, thank you for this. So I haven't looked at it. They must have made an adjustment, right? So look at that, eh? So total US unfunded liabilities. I said six times. I'm off. It's five times, I guess.
I forgive you in your math. Quick, back in the math.
But look at this. Look, isn't this $157 trillion of unfunded liabilities? You put the national debt. I always say it's 30 trillion. We're not quite there. But you're at 190 trillion US dollars.
Yeah.
Do you understand how big a number that is? Well, I know you do. Most of the world has no clue what that means. How many days of, if you say, what is a trillion? How many days goes into a trillion versus a billion? It's just,
it's like 31,000 or 32,000.
I don't know. You know what? I mean, let's not get people too bogged down in the maths of this. The truth is 190 trillion total US funded plus unfunded liabilities. It's over. It is so over. It's not funny. You need to insure against this.
Yeah. And so I know you and Dylan have both brought up multiple times that the stock market or the overall equity markets would have to expand at 12% a year. Now, where we are currently, obviously that could get worse with more money printing in order to cover those liabilities that, or
only the funded liabilities, not even including the unfunded, right?
I didn't even realize that when you guys were bringing.
Oh yeah, no, it's only the funded liabilities. So we don't even bring in the unfunded liabilities.
Oh my God. Yeah,
oh my God is right.
It's like, I didn't even realize how bad it was. I know this is the total debt to GDP. And I think
this is a really cool thing. This is so total debt to GDP, but don't forget, that's only federal debt. You have to remember that there's total bank debt, there's state debt. The total number that just came out tonight that Dylan accurately shared in his article on stagflation that I tweeted around because it's a great article, like 5 minutes before we got on this. He accurately shows that total global debt to total global GDP is 400% or 389%. Okay, Chris, this one shows 140%. Well, look, the reality is total global debt's 400% to global GDP.
Yeah.
And that's why you can't solve it, because 12% assumes an average coupon on that debt of 3% on the numerator.
Yeah.
So 4 times 3 is 12, which means the denominator needs to grow at 12% per annum just to keep.
And the last time I checked, I think the 10-year treasury is at 1.4%, 1.2, 1.5.
No, 1.5. Use 1.5 right now.
1.5. And then the 30 years, what? 2.2?
2.5.
2.5-ish. So that's still even below funding what we would need, like you said, like at least 3%.
Okay. So, but don't forget, U.S. total debt includes not just treasury debt, but it includes the coupons of higher risk or lower rated borrowers, which means the average coupon is probably even higher than 3%.
Oh, okay. Yes, I see what you're saying.
So we use 3% as a conservative number, and it still shows the impossibility of growth or keeping up with the growth of the interest coupon.
Yeah, I hope you like that chart. But yeah,
I love it, man. I mean, it's so good. But by the same token, do you know how few people actually even appreciate what that means?
Very few. I mean, I have a lot of my friends like you. I was an engineer, and a lot of my buddies are engineers as well. So they're all I've gotten them all into Bitcoin through that. And there's definitely even I hate saying this, but it's like things have to get worse before they get better. And while Bitcoin's a solution.
Okay, well, sorry. So when you say has to get worse, it will never get better. This is what we need to understand. It is not getting better, you guys. It is absolute certainty. And using a physics analogy, the debt spiral is going to accelerate. Escape velocity is impossible.
Yeah.
It's getting worse faster. Acceleration is picking up. That's what happens when you get into a debt spiral.
Yeah.
So it ain't getting better. I hate to be a bearer of bad news, but it ain't getting better. You have to take your hedge. You hope that the system doesn't collapse on itself. You hope it doesn't go into a black hole where, it just sucks everything in and just disappears. I don't want to be an Armageddon. I want the USA to survive. The USA needs to embrace Bitcoin as a store of value. Mm-hmm. That first and foremost. And the Chinese government has served it up like a platter, a gift. If the US was as smart as I know they are, there's a lot of people understanding the implications of the Chinese banning of mining and how advantageous that is to the West.
It really is. And, I won't get into name slinging of various politicians that are for it or against it or one way or the other, but you would hope that they would just coalesce together and be like, listen, this is kind of.
You can hope all you want, but you realize that many of these people are lawyers and they're just not mathematicians. And the first person you need to point a finger at is Jerome Powell. Like there's no problem with being a lawyer, but the reality is lawyers aren't always the best risk managers. And look, again, I don't want the US to fail. I need to be very clear about that. So I'd advocate a system where your fiat currency is your checking account and Bitcoin as a store of value is your savings account. And the two can be parallel systems, but you don't save your money in your checking account. You use your checking account for short-term transactions to satisfy groceries, to cost of living, everything like that. But your savings account is a different, technologically superior form of money called Bitcoin, which is programmed to store the value of your time and energy.
For sure. So I guess I don't really have any more with the episode there. Thanks so much, Greg. I'm going to ask you a few follow-up questions or wrap-up questions, and then we can sign off. I really appreciate this.
Well, by the way, I'm not rushing off unless this is totally your time that you like to keep your episode too. So
we can keep going if you want.
You tell me what you'd like, but here, go ahead. Ask me some questions. I don't have a plan. I sort of blocked off an hour and 10 minutes. So as I look at 8:40 p.m. I probably have another 30 minutes if you want it, or 10 minutes or 0 minutes. It's up to you.
Yeah, we'll do another 10 minutes then, and then I'll do the follow-up or the wrap-up questions. So
okay.
I guess pivoting to a little bit different. I won't name any, I won't put you in a spot of naming any economists or gold bugs out there,
Mm-hmm.
but I guess the people that are so vehemently against Bitcoin, would you just say, even just looking at from risk chair or looking at from your perspective, is it just their conflict of interest or just lack of understanding, or is it, what, I guess, how would you piece it together?
How about we put it to the positive? I met, so I was on the, lucky enough to be on a panel down in Bretton Woods, New Hampshire. And the organizers, which was Blockworks, invited a bunch of pro Bitcoiners and anti-Bitcoiners to the panel. And you got to you always have to listen to the arguments of people that don't agree with you, because you may be wrong, right? Don't read research that confirms your bias. Read research that goes against your investment thesis to make sure that you're not missing something. So you always listen to these guys. And I'll just tell you this, gold bugs get it. Yeah. Okay. Same problems, but Bitcoin, in my opinion, is a superior technology. Okay. And the most refreshing thing to do is to meet a gold bug who actually gets it as well and says, you don't have to have all of your hard assets in gold. You can have some of your hard assets in a superior form of gold. They may not say superior. I will say a superior form of gold, or I'll take it one step further. Bitcoin is actually digital energy, but just talking about positive people or people who are gold bugs who actually embrace Bitcoin, Luke Groman, Larry Lepard, okay? Lawrence Lepard is a brilliant risk manager. He's a gold bug. He believes that both of them will work their magic as a store of value. And I'm not arguing with him. I own gold. Okay. I don't own as much gold as I own Bitcoin. But the truth is that you always have to put your hard assets in a diversified basket as well. Don't hold store of value in fiat. That is the first and foremost. And when I say that, what is a bond? Just going back to it, it's a fiat contract. So let's pick on stupid asset managers called bond guys, not gold bugs. They get it. Now, there are some gold bugs that you could argue are conflicted. And much like a banker, they may know the right answer and they pretend they fumbled the ball on the 1 yard line as they've successfully navigated 99 yards on a kickoff return, and they fumble the ball as they're about to go into the Bitcoin end zone. That'll fix itself over time. The smart risk managers and the smart gold bugs are starting to embrace Bitcoin. It just happens to be a superior technology with a fixed supply. It's more easily verifiable, transportable, divisible. You know all the things. At the end of the day, though, my God, if you embraced gold for a reason, you're 99% of the way there. You understand that the enemy is the fiat Ponzi. The enemy is not a gold bug. The enemy is not a Bitcoiner. We're both speaking the same language.
I agree. I completely agree. I don't personally own any physical gold. I know I've considered it, especially with everything that went on.
You're young, man. Look, you're young. I'm old. Okay. I'm old. And by the way, look, I never embraced gold in 1988 as the purest store of value. I should have, but it had just come off a huge high and it came down. I put my savings at that time into a fixed asset called real estate. Because you know what? Real estate's not a bad hard asset either. Mm-hmm. And I'll just throw this out though, but understand you're not making money on your house per se. You're making money on your house when you measure it against a debasing fiat currency. But if you measured your house price against gold, over time, it's about stable, as it should be. Okay. Yeah. Stock market returns against gold are about zero after or before accounting for dividends, as they should be. It makes sense.
Yeah.
Okay. It's all about the unit of account you use called this stupid fiat Ponzi, where they continue to print more of it to make it seem like people are getting rich, when in fact, all they're doing is penalizing the poor, because the poor don't own any of these assets called that we just talked about. They don't own house. They don't own gold. They don't own Bitcoin. They own and save in fiat dollars, and those fiat dollars continue to get less and less purchasing power over time.
I completely agree. And I mean, even just using a simple just test of it, look at where we were of March of 2020 to where we are today. Would you say the economy is in a better place than it was now versus then? You know, many people would say no, even though the stock market's hitting all-time highs. Obviously,
I would definitely say it is. Okay, you have to look at the statistics. It's no question it is, but it's not as it is not relative to the improvement in the stock market. It's it's better, but it's not exponentially better like the stock market would imply.
Exactly. So I guess bringing cold bugs in, like they said, you've basically gotten all the way there, and we share a lot of commonalities between doing that. I love Saylor's analogy. I mean, him being an engineer, both of us being engineers, his analogy of if you had $1 billion of gold or $1 billion of Bitcoin, do the test of how to move it from New York to California.
I like his other tests even better. Okay. I think it was him, but if it wasn't, I'm going to attribute it to him because the guy is really, he's a walking computer mainframe. Okay. Plus he can talk, most walking computer, engineers, like the smartest people I've ever met in my life are engineers, but half of them can't even talk. They talk mathematics, but they talk gibberish when they try and talk English or whatever their native tongue is. Saylor has mastered both the first layer of language, which is math, and the second layer of language, which is his native tongue. Anyway, here's what I would attribute to him, whether he said it or not. If the price of gold overnight magically, or not even magically, just happened to double in price, so it goes from whatever it is today, 2,000, somewhere around $2,000 an ounce to $4,000 an ounce. Gold supply historically is about 2% a year, but that moves. But if it doubles overnight, do you think next year's gold supply will stay stagnant at 2%? Come on, not even close. Plus, you don't know. But the beautiful thing about Bitcoin is it's agnostic to price. You know what the supply will be. You know, math and code, the halving cycles, it's just a thing of beauty. And anyone who doesn't believe that it's a living, breathing organism, go to tradeblock.com and watch the Bitcoin blockchain in action and tell me it is not a thing of visual beauty, where you're seeing hashes going across the screen for different amounts of value. And they are put into a block, and every 10 minutes, these blocks are mined, and it attributes the fees, and it attributes the miner, and it recreates the ledger forever. And I mean, come on, guys, it's just absolutely beautiful. And if you're intellectually lazy and you haven't even gone to that page and looked at it, which I guarantee you Peter Schiff hasn't, or if he has, then he's being conflicted by not giving good advice. There's so many people that just don't do the work.
I completely agree. Like I like the sailor analogy of moving gold versus moving Bitcoin. One's 1,000 hours, one's 1 hour. One costs about $5 million to do. The other one costs $5 to move $1 billion.
I love the guy too, but there's so many better things in my opinion than just that little argument.
Oh, I completely agree. Luckily for Peter, I mean, his son's a big Bitcoiner. I know you sent Spencer Bitcoin on his birthday. And even me doing the show, the Peter Schiffs of the world are not going to be the ones that, struggle. I mean, he has enough assets. Just looking up his net worth, just doing a simple Google, he's not going to be the ones that struggle.
No, you're totally right.
People that need to invest and need to understand.
People at the bottom. It's, as I told you, it's the people, it's the less privileged. I'm a privileged guy too. And I'm proud of the work I've put in to attain a certain level of security in my life. But I'm not doing this despite some Bitcoiners out there that accuse me of being here on the space to promote my popularity or my net worth. Look, I'm here to help the bottom of the less privileged at the bottom of the spectrum. And I don't want to classify, but the reality is there's a wealth spectrum. My good friend, Jeff Booth, fellow Canadian Bitcoiner, wrote the best book I've ever read, by the way, called Price of Tomorrow. Jeff Booth says the same thing. It's not we're altruistic by any means. It's because we're trying to do this not just for my kids, but for the kids of the world that are being abused by the present political class that's pulling forward all the gains that should be accruing to our kids. We're just so darn selfish and greedy that we're pulling it forward at the expense of the future generations. And that's just not right.
I completely agree. And, Mr. Powell said something a couple of weeks ago saying, oh, no one's coming to my office to say that we should stop money printing. I know he's saying it kind of tongue in cheek, but,
where's his office? If that's a challenge, I'll go there tomorrow. He actually understands. Well, I won't. There's a lady by the name of Danielle DiMartino Booth who was at the New Hampshire event, and wow, did she ever say some eye-opening comments about the Fed president? And I'm not going to repeat them, and I will attribute them to her as opening my eyes, but I'll leave it at that. Okay.
I'd love to see the talk if it's up sometime on YouTube or something.
I don't think everything was. You could probably find it. Try and see where she was on stage at Bretton Woods, New Hampshire.
Okay.
And let me just tell you, I wrote those in my notebook and I was like, wow, I like this lady. She has some really serious guts to take those things public.
She's she works for Stansberry. Is that correct? Stansberry Investments. Is that right or no?
You know what? I don't know who she works for. I've certainly seen her. That sounds right. Okay. She's Danielle DiMartino Booth. So that sounds right.
I've seen her work before. I like her a lot as well. All right.
She tells the truth. You can't, what's the problem with telling the truth?
Yeah. I mean, that's ultimately what we're looking for with Bitcoin, it seems. Greg, thank you so much for coming on. It's been a pleasure having you on. I really appreciate the insights. I'm still going to call you legendary investor Greg Foss.
Oh, man. I appreciate that, Chris. Tell me a bit about yourself before you run. Where did you go to school? And I know you live in New Jersey, but...
Yeah, so I went to school in South Jersey. Went to Rowan University, chemical engineer by trade. So graduated high school in 2011, graduated college in 2015. Ultimately started the Amateur Investors in November or December timeframe of 2020. Was kind of going down my own financial journey, not being able to go to the bars and hang out with my friends as much. But, I've always had a love for the markets and ultimately fell down the rabbit hole probably in June.
Well, keep up the great work. There's young kids like Dylan LeClaire. We brought him up, I think, on this podcast, didn't we? Yep. I lose track of the different podcasts I've done and stuff. But
Dylan, I had Will Clemente on before he went on Pomp's show. That's my claim to fame.
Listen, he's just crushing it right now. These are smart kids. Like, include yourself in there. That's what gives me hope as a 58-year-old fat man with, with 3 kids that I truly love and care about. And all I'll say is, people need to come out and tell the truth, because too many people are sugarcoating a future that's not so bright. If you just keep printing money, you cannot print yourself to prosperity, people. It is simple mathematics spewed by people who have never sat in a risk chair. That is the truth. Don't listen to endowed chairs from universities. They have no clue how the world really works.
I completely agree. I appreciate the kind words. Thank you so much. I'll ask you a few more questions to wrap up, and then, this episode will be a wrap. So I guess it's been a pleasure having you on the Amateur Investors. I guess, what's been your biggest investing mistake? Getting ready to cut into the chase.
That's okay. So my biggest investing mistake, I got to say this because I got to tell the truth. I invested about $250,000 in a Bitcoin startup in Canada, which on a pure investment, I would have done far better putting my money directly into Bitcoin at under $1,000 a Bitcoin and riding it up 50-fold. You can do the math on how much I would have made on that. But I ended up helping fund a startup in Canada, which brought the first Bitcoin closed-end ETF to Canada. And then actually that was the precursor to the Bitcoin ETFs that started in Canada. It was an investing mistake because it was based on a dream that Canada would be a leader, and they actually succeeded. But it was a mistake because you should have just put your money right in the pure coin. It had more liquidity. It was not subject to the sometimes, how would we say, sometimes the mistaken management decisions that were made at that company. That being said, I need to make sure everyone understands I'm still very happy to have been part of that, because we brought something to the investing public in Canada that benefits their ability to put assets at risk on a tax advantage basis in the Bitcoin ecosystem. So good and bad. From a pure investment, it was a mistake. From a pure being proud of what you've helped to contribute to the Canadian ecosystem, it was a success.
Yeah, I agree. I mean, I prefer personally owning Bitcoin itself rather than in a retirement account. But I know once the U.S. finally gets an ETF officially, that's not named MicroStrategy, but an official.
Well, here's the thing, right? You got to take advantage of the fact that the tax man will pay you 50%.
Yeah.
Or will absorb 50% of the cost of your Bitcoin. So you essentially can purchase 50% more Bitcoin on an after-tax basis.
Yeah, that's
quite simple. Look, I know not your keys, not your coins, but at full stop on this, you can own both cold storage and Bitcoin in your RRA or your RSP.
That's true.
And if the government's going to subsidize a 50% of your purchase, don't tell me that you're too smart by a half and just say, well, not your keys, not your coin. Then you're hoping for the world to unravel, and that is not the outcome that you want.
Yeah, definitely. All right, next one. What's your favorite book, podcast, YouTube channel, or website that you like to go for looking for investing information or just studying?
Well, I mentioned my favorite book, and that's the book by Jeff Booth called
I still haven't read it. It's on
Okay,
my
well,
list.
I need to tell you, man, it is the best book I've ever read. Okay, I took 8 pages of notes, but it just is written very well, because he has the experience of starting a high-tech company and living the cycle of that high-tech company, and then looks at the problems that are in the world from a financial perspective that, actually, I had written my paper. I wrote a paper on why every fixed income portfolio needed to own Bitcoin as portfolio insurance. And the statistics that I used in my paper, I was very happy with them. I had researched them all myself. And I published my paper, and then I read Jeff Booth's book, and it was amazing that he used the same statistics and generally drew the same conclusion. And I'm not saying that either of us are incredibly smart. It's just to say that nobody else publishes these statistics or promotes these statistics, because if the investment banks did, the world would be like, whoa, what the heck? How is it possible? But the investment banks turn a blind eye because the investment banks need to pretend that we can keep this fiat Ponzi going, right? So that's why Jamie Dimon is like, you shouldn't own Bitcoin. If you trade Bitcoin, you're going to be fired. Hey, you know what, Jamie? You know, you can manage your risk however you want, but I know you're smart enough to realize what you're saying is actually not telling the truth. And he does. I can call him out on it. He can deny it. He can say, who's this idiot Canadian calling me out? I'm worth 25 times what he's worth. And that's true, but I'm still going to call him out.
Yeah, I appreciate that. All right. Last thing. Thanks so much for your time. I guess a shout out to where people can learn more about you and your business, Twitter, whatever you want to put.
Yeah, look, I'm on Twitter. I've sort of discovered this platform. I am involved in a business. It's an energy business where our clients are off takers that mine Bitcoin. I'm not promoting that out of the very, the Bitcoin community has at times accused me of being here just because I'm trying to promo myself. I want to make sure that you understand I'm here because I care about my kids, and I'm not defending myself to anybody. I'm old enough to live with my own comfort level in terms of what I'm doing and why I'm doing it. I'll just say this: my Twitter handle @Foss, Greg Foss. I try and call out pretenders. Sometimes I'm not always polite about it. Sometimes I offend people. I have 3 kids. I do it because I'm calling out people who are not working in the best interest of my 3 kids. And if they're not working in the best interest of my 3 kids, I promise you they're not working in the best interest of your 3 kids either. Yeah. So I'm there. Call me out. You can send me hate mail. I'm okay with it. At the end of the day, you better study math. Okay. Very simple. It is a very concerning situation.
Thanks so much, Greg. That's a wrap for this episode. Great episode. You can obviously check out theamateurinvestors.squarespace.com. Obviously, give us a like and a follow, and love to see any comments that are not bots on YouTube. So thanks, everyone. Have a good one.